Picture two cavemen. One of them has a spear. The other one wants the spear, but he hasn't caught anything today, so he can't trade for it right now. What he can do is promise. Give me the spear now, I'll give you 2 rabbits when I catch them. The first caveman thinks about it and says no. Not because he doesn't like the second guy, because a promise isn't a rabbit. You can't eat a promise, and if the second guy wanders off to another cave system next week, that promise is worth exactly nothing. That's the entire problem repossession exists to solve, and it's older than currency, older than writing, older than the wheel. Most people assume repossession is a modern invention, something dreamed up by banks and finance departments to make life miserable for people with bad credit. It isn't. It's one of the oldest ideas humans ever had. And the tow truck idling outside your neighbor's house at 2 a.m. is just the latest costume it's wearing. So let's actually build this thing from the ground up, the way our 2 cavemen would have had to. Because once you understand why they couldn't just trade on promises, you understand exactly why your car loan works the way it does. Go back to the spear. The first caveman's hesitation isn't irrational. It's the correct read of the situation. Lending to a stranger only works if there's some way to guarantee the debt gets paid, even if the person defaults, dies, or simply decides not to bother. Inside a small tribe, this problem mostly solves itself through reputation. Everyone knows everyone, and a broken promise follows you around for the rest of your life. But the moment you're trading with someone from outside your circle, someone whose future behavior you can't predict and whose reputation you can't check, reputation alone stops being enough. So a second idea shows up right alongside the first one: collateral. Instead of trusting a promise, you hold something valuable until the promise is kept. The second caveman hands over his fur cloak. He gets the spear. If the rabbits show up, he gets the cloak back. If they don't, the first caveman keeps the cloak and calls it even. Nobody has to trust anybody. The object does the trusting for them. This is, mechanically, a security interest. It's the exact same structure written into every car loan signed this week, just without the paperwork. And it already contains the seed of repossession. Because notice what happens if the second caveman refuses to hand back the cloak after failing to deliver the rabbits. The first caveman doesn't sue him. There's no court. He just takes it back, by force if necessary, because everyone in that world already agrees the cloak was never fully his to keep. Fast forward past the caveman, and the idea doesn't go away. It gets formalized. Ancient Babylonian law under Hammurabi had provisions for creditors seizing a debtor's property, and in some cases, the debtor's family, when a loan went unpaid. Roman law developed a specific legal category for this, called pignus, a pledge, where a debtor handed over physical possession of an item as security, and the creditor could sell it if the debt wasn't repaid. Medieval English common law built its own version, the chattel mortgage, which let a lender hold a legal claim on movable property, livestock, tools, wagons, without ever taking physical possession of it in the meantime. That last piece is the important evolution, because it's the one that made your car loan possible. Under a chattel mortgage, you keep using the thing. You keep the wagon, you keep working the field with it. But the lender holds a legal interest in it that only converts into actual seizure if you stop paying. That's a fundamentally different arrangement than the caveman's cloak, and it required a legal system sophisticated enough to say, this object is yours to use, but not fully yours to own until a debt is cleared. By the time American law caught up to the automobile in the early 20th century, this whole lineage got compressed into a single modern framework, Article 9 of the Uniform Commercial Code, the section of law that governs secured transactions in nearly every U.S. state today. And buried inside Article 9 is a provision that would make total sense to the caveman, and complete sense to almost nobody who's actually experienced it. A lender doesn't need to go to court to take back a car. They're allowed to just take it, as long as they don't breach the peace while doing it. Sit with that for a second, because it's genuinely unusual. In almost every other area of American property law, if you want to take something away from someone who possesses it, you need a judge, a hearing, a court order. Not here. A creditor with a valid security interest in a vehicle can send an agent to physically remove that car from a driveway, a parking lot, or a public street with zero advance warning and zero judicial involvement, provided the repossession doesn't involve breaking into a locked structure, physical confrontation, or anything a court would later classify as disturbing the peace. This is called self-help repossession, and it exists for the same reason the caveman didn't need a judge to take his cloak back. The legal system decided, deliberately, that requiring a court process for every single vehicle repossession would be so slow and so expensive that auto lending to anyone without pristine credit would simply stop existing. If a lender had to wait 6 months and pay legal fees every time a borrower missed payments, the risk of lending to a first-time buyer or someone rebuilding their credit would be too high to bother. Self-help repossession is the trade-off that makes that lending possible in the first place. It's not a loophole, it's the load-bearing wall of the entire industry. Which means when you sign a car loan, you are not just borrowing money. You're pre-authorizing, in writing, on page 4 of a document you probably skimmed, someone else's legal right to walk onto your property and take your car back without telling you first. Here's where it's worth slowing down, because the car is collateral sounds simple and hides something people miss constantly. The lender's actual legal claim isn't on the physical vehicle sitting in your driveway. It's on the title, the paper record the state maintains showing who has an ownership interest in that vehicle. When you finance a car, the lender's name goes on that title as a lien holder, and it stays there until the loan is paid off. You can drive the car, insure it, paint it, crash it, but you cannot legally sell it free and clear to someone else while that lien exists, because the title itself carries the lender's claim along with it. This is why repossession doesn't require proving anything about your specific circumstances. The lender doesn't need to demonstrate you're a bad person or a flight risk. They just need to point at the title and the payment record. The system was built to be indifferent to the story, on purpose, because a system that had to evaluate every borrower's excuses individually would collapse under its own slowness. And this is also why, when a lender's own claim to that title turns out to be shakier than it looks on paper, the entire structure can come apart at a scale that has nothing to do with any individual borrower missing a payment. In September 2025, one of the largest subprime auto lenders and used car retailers in the country, Tricolor Holdings, a Dallas-based company that had grown to roughly 65 dealerships across Texas, California, Nevada, and Arizona, filed for Chapter 7 bankruptcy and shut down virtually overnight. This wasn't a company that ran out of borrowers. By 2025, Tricolor employed more than 1,500 people, generated roughly $1 billion in annual revenue in both 2023 and 2024, and had over 60,000 outstanding car loans at the time of its collapse. It specialized in lending to buyers with little or no traditional credit history, funding that lending by borrowing short-term money from major banks and then bundling and reselling the loans it originated. What actually brought it down had nothing to do with a wave of borrowers stopping their payments. Warehouse lenders uncovered alleged fraudulent activity at Tricolor, including double pledging of collateral and irregularities in loan tapes and audited financial statements. In plain language, prosecutors later alleged the company had used the same pool of car loans as collateral for multiple separate lines of credit at once, the equivalent of promising the same cloak to 3 different people simultaneously. Federal prosecutors ultimately charged the founder and chief operating officer with running a scheme that allegedly double-pledged approximately $800 million in collateral, and major banks, including JP Morgan and Fifth Third, disclosed more than $340 million in combined losses. Think back to the caveman for a second. The entire system only functions because the collateral is real and singular. One cloak securing one promise. The moment someone figures out how to pledge the same cloak to multiple people at once, the whole mechanism that lets strangers lend to strangers stops working. And it doesn't fail quietly. It fails all at once, for everyone connected to it, which is exactly what happened here. Tricolor's collapse left roughly 10,000 vehicles and around 100,000 loan accounts in legal limbo as collateral for hundreds of millions of dollars in creditor claims. And it rattled banks and bond markets that had nothing directly to do with any individual borrower's car payment. Zoom back down from the collapse of an entire lending company to the individual moment a vehicle actually gets repossessed, and you find an industry running on surprisingly thin margins for something that generates so much anxiety. The flat fee a repossession agency earns for successfully recovering a single vehicle has sat somewhere between roughly $200 and $500 for years, largely unchanged even as fuel, insurance, tow equipment, licensing, and bonding costs have all climbed. Agents typically work on a pure contingency basis, meaning if they don't recover the vehicle, they don't get paid at all, regardless of how much time they spent trying. That contingency structure shapes the entire industry's behavior. It means recovery agents are financially motivated to move fast and take the vehicle whenever a lawful opportunity presents itself. Because a car left sitting in a driveway for one more day is a car someone else might get to first, or a car the borrower might successfully hide. And it means the pressure of the job falls disproportionately on the individual agent standing in a driveway at night, working alone, unpaid until the moment metal actually moves. Meanwhile, the volume flowing into that system has surged. Roughly 1.73 million vehicles were repossessed in 2024, a sharp jump from prior years, even as recovery rates have fallen, by some industry measures from around 41% before the pandemic down to roughly 31% today. Fewer vehicles are actually being successfully recovered relative to how many repossession orders are going out, which tells you the system is straining under its own volume, even before you ask why that volume exists in the first place. This is the part that connects directly back to the caveman's original problem. How do you lend to someone whose ability to repay you can't be verified through reputation alone? The honest answer in the current market is that lenders have been doing it at a scale and on terms that are now visibly buckling. Americans now carry $1.69 trillion in total auto debt, and subprime borrowers, those with the weakest credit histories, have pushed delinquency rates to their highest level in more than 3 decades of tracking. Fitch Ratings recorded 6.80% of subprime auto loans at least 60 days past due in February 2026, a figure that has stayed near record territory since early 2025. Part of what's driving this is the shape of the loans themselves. Average monthly payments have climbed past $750 for new cars and around $540 for used ones, pushed up by both vehicle prices and rising interest rates, while many subprime borrowers are stretched into longer loan terms on vehicles that are losing value faster than the loan balance shrinks. A borrower in that position isn't reckless. They're underwater through arithmetic. The car depreciates faster than the debt against it does, and once income gets squeezed by rent, groceries, or a single missed paycheck, the loan is often the first thing that stops getting paid, precisely because the lender's only real leverage, that self-help repossession clause, kicks in automatically the moment payments stop, with no negotiation required. Step back out to the widest possible view, and the whole system, ancient pledge law, medieval chattel mortgages, modern UCC Article 9, self-help repossession, subprime auto securitization, a fraud-driven bankruptcy that vaporized a billion-dollar lender overnight, a repo agent working a contingency fee in a stranger's driveway at midnight, is really one continuous answer to a single question the first caveman asked when he refused to hand over his spear for a promise. How do you make a stranger's word enforceable without a court, a police force, or a shared history to fall back on? The answer humans arrived at, and never really abandoned, is that a promise becomes reliable the moment it's backed by something real that can be taken back. Every layer of law added since then, Hammurabi's Code, Roman Pignus, English chattel mortgages, the UCC, has just been refining the mechanics of that one idea, making it faster, more standardized, and more automatic. Repossession isn't a punishment bolted onto lending as an afterthought. It's the thing that makes lending to strangers possible at all. Aww. And it has been since long before anyone thought to write it down. So the next time a tow truck rolls silently down a street at night to take back a car nobody's been paying for, it's worth remembering it isn't really a 21st century invention doing something new. It's a caveman's cloak, wearing a very long chain of increasingly formal disguises, doing exactly what it's always done. If this changed how you think about something you thought you already understood, that's the whole point of this channel. If you enjoyed it, drop a like and subscribe. It genuinely motivates me to keep making videos like this. And if you've got a topic you want broken down this way, drop it in the comments. I read all of them.